Well, I made a mistake here, and I'm not going to forgive myself for the mistake I made here. In fact, I made not one, two, but three mistakes here, which I will discuss with you. So we learn from our mistakes. But what I have done here is not forgivable. Okay. So let's see what happened here. So I bought the stock at the yellow line on this candle. Now, let me give you some context here. Why did I buy the stock at that candle? You see this base, there was a buy point here. So I had bought this stock here. Just a second. I had bought this stock here. I had sold here somewhere. I made 16% in this stock. So I was able to afford the risk. I could take some extra risk. So since I had already made money in the stock, I decided, though, okay, I can now, from a risk management point of view, I can afford to violate some of my rules. Okay. So that is why I tried to get into a stock early as it was forming another base. And that turned out to be a mistake. Let me explain. I will remove this line. You see this base here. This is 0.1. This is 0.2. So I have drawn the base here. It has got the green zone, the blue zone, and the red zone. The first quarter, the second quarter, and the lower half. The moving averages are in place. Okay, the 50-day moving average is above the 150-day, and the 150-day is above the 200-day. So that's a stage 2 stock. No problem there. Now, I bought the stock on this day. So this is what I saw just before buying. This is what I saw. And these are some of my notes which I use before buying the stock. I will explain to you what this is. But have a look at this base. Let's count the number of candles. So this is the first candle. I don't count this candle. 1, 2, 3, 4, 5, 6, 7, 8, 9. So I personally need minimum 10 candles in the base. But here you have only 9. Still, I decided that I will buy the stock. So this is my first violation. I violated my own rule. Now, why did I violate my rule? Why did I decided to get into the stock early? Well, there are reasons for this. See, first reason, I already made money in the stock, so I can take some risk. Second reason, if you see as the base is forming, the price is contracting and the volume is contracting. This is a classic sign of institutional accumulation. Third reason, the stock has not given up too much of its return. See, if we measure from here till the low, it has hardly given up 11% of its gain from the top. Okay. So the stock is not giving away any money. The price is contracting. The volume is contracting. You see this number 90, that's the relative strength of the stock. So the stock is already doing better than 90% of all the stocks in the Indian stock market based on the 52-week performance. So all of these factors are in my favor. Plus the buyer demand is B, which means institutions are accumulating the stock. Plus the industry ranking is 13, which means it comes in the top 10 percentile or top 5 percentile of the industries. So it is in the best performing industry group. Recent quarter earnings growth is 64%. Recent quarter sales growth is 44%. I mean, what else? What else do we need in a stock like this? Okay. So price contracting, volume contracting, stock has not given up too much of return, relative strength is high, there is institutional demand, the industry group rank is fantastic, below 20. So everything that I want in a stock is in place. So why wait for that additional candle? Why not just jump in whenever the stock makes a move? And all of these factors point towards the fact that the stock could anytime make a big move. And it did. It did. On that day, it opened. On this day, on 19th of August, it opened with a gap up. This is a gap up opening. Okay. Look at the closing and look at the opening of this candle. is suddenly shot up 5% on the opening itself. I said this is the candle that is likely to push the stock up even higher, but I still waited. One of my rules is that if the stock opens above the yellow line, it is very dangerous to buy, because after it opens above the yellow line, it could start coming down, trigger my order at yellow line, get the shares filled in. So I get the shares, my order gets filled, and the stock continues to go down. So I end up losing money. I want to avoid that from happening. That is why I don't buy a stock when the price opens above the yellow line. But in this case, as you know, as you can see, I have already convinced myself that the stock is likely to go up. So I thought that the stock will run away from me. So I waited for the first few minutes. As the stock came close to the yellow line, I immediately bought 5% because I thought that that would be the low of that particular day. The stock would bounce from the yellow line and continue its journey forward, because I also saw volume coming into the stock. Okay, that's how I ended up buying. And once I make a commitment, my first step is to keep an 8% stop loss, which is the red line. This is 8% below the yellow line. Okay. So 8% is my stop loss. Plus, I also like to keep a mental stop loss. So if you see here, if I draw the base for you, so this is 0.1, this is 0.2, that's 0.3, that's 0.4, and 0.5. There are 5 points in the base. I need minimum 4 points in the base. Okay. So I decided that at point number 4, I will keep my mental stop loss, which is the blue line, the low of this candle. What is the meaning of mental stop loss? Well, if the stock closes below the yellow line on the daily time frame chart, on that particular day, just 5 minutes before it closes below the yellow line, below the blue line, I will uh, sell all my shares. That's called as a mental stop loss. I will not wait for the price to go to the red line and trigger my stop loss. I will sell early. So I normally keep a hard stop where this red line is where in my broking terminal I keep the proper automatic sell order. And the blue line is not an automatic sell order in my broking platform. It's a mental stop loss. I am watching that level. Okay. I am watching that level. If it closes below that level, I'm going to be out of the stock. Now, as you can see here, the stock was down. I started losing money from day one, but it did not close below the blue line. That was a bit encouraging. So I decided, okay, let me give the stock a week. I think this was a Monday. Let me give the stock till Friday and see what happens. Maybe it can recover because the relative strength was very high. Industry rank is very high. Earnings and sales are there. I mean, there was nothing wrong about the stock. In fact, if I had just bought the shares that I had bought here, if I had just held on to those shares and not sold here, I would have done much better. Okay. But we make mistakes, our emotions come into play, and we tend to violate our rules. The first rule that I violated here is that I bought even if the price opened above the yellow line. The second rule I violated here is that I bought even if there were only 9 candles in the base. Okay. Next. And I decided to stay there till it remains, as long as it remains above the blue line. Now look what happens. Did not recover. Next candle. Again, did not recover. Next candle. Does not recover. Again, next candle. Does not recover. Okay. So by the time this green candle came, okay, by the way, this is today's candle. The market is live right now. It is 26th August as I record this video. Okay, this video might be published much later, but as I'm recording this, this is the candle that is forming, and this is the candle where I have sold the stock. Now, if you see this 5 candle, Monday, Tuesday, Wednesday, Thursday, Friday, it shows no sign of recovery. In fact, on this day, 23rd August, it shows above average volume but weak closing. What does that mean? That means probably some of the institutions are selling, but we don't get we get mixed evidence here. Okay, because see, high volume weak close means institutions are selling. But if institutions are selling, why is the price going up? Why did the price not cut the blue line and the red line. So this, it's like a mixed signal. I don't know what to do here. Okay. But I gave the stock an entire week. It did not recover. So the stock is not showing strength. On Monday, which is today, 26th of August, I thought the stock will give a nice gap up opening because it's Monday, it's fresh, it's the weekend effect. People want to jump into the stock. But see, poor opening, okay, and poor price action, hardly any volume. I said, no, the stock is not showing strength. By the time this candle opened, my loss was 4%. Okay. So I said, okay, rather than taking 8% loss, if it crashes down, why not just take 4% loss and just get out of it? Okay. Because if this hits 8% stop loss, then I will lose 8% on a 5% position size. And when I bought here, this was a 2.5% position size, and I made 16%. So making 16% on a 2.5% position size is almost equal to losing 8% on a 5% position size. So I would end up with no loss, no profit, right? So in order to protect the gains that I've already made here, I decided to sell the stock with a market order. Okay. So I quickly realized my mistake and I said, okay, I have done too many mistakes here. I have violated too many of my rules here. The stock is not showing the strength in terms of price and volume, which I expect from it. Let me get out of it. Maybe when it forms the next base, I will try to jump back into the stock again. Okay. So that is the reason why I exited the stock. So this was really unnecessary. That is why I said, I'm not going to forgive myself for making this mistake. And by the way, I said that I will explain these numbers to you. So this first number, this is called as the master score. This is the score given by MarketSmith based on fundamental and technical factors. As long as it is more than 80, it is good. 76, this number is the earnings rating. So the stock is doing better than 76% of all other stocks in the Indian stock market if we look at its earnings and earnings growth and stability. 90 is the price strength, which you already know. B is the institutional demand. If it's A or B, it represents institutional demand. 13 is the rank of the stock. As long as this number is below 40, it is considered very good. 64% is the quarterly earnings growth. 44% is the quarterly sales growth. 4 is the stage or the base count on a weekly chart. So it is in the fourth stage base, which means it is in a late stage base. So the stock has already given a big move before reaching here. This is another factor which I did not consider while getting into the stock. Normally, stage 1 and stage 2 are the best times to buy the stock because you are buying early. By the time you reach the fourth and the fifth and the sixth stage, it becomes riskier to buy the stock. The position size has to be small. Okay. And this is the stock that I have decided to buy on the daily time frame, not the weekly time frame. I looked at the daily time frame chart. I've decided the level based on the daily time frame, which is the high of this candle. That's why I write D here. But if I'm taking a trade on the weekly chart, I would write W here. So this is like a code that I use, like a shorthand format. This quickly tells me what I am getting into just before putting the order. But anyways, I hope you understand what I'm trying to convey here. The moral of the story is no matter what happens, please do not violate the rules. What is the worst thing that can happen? The worst thing is that the stock will run away from you. Let it go. Okay. You will get other opportunities. So I have learned from my mistake. I will not make this mistake again, hopefully. Thank you so much.